Well, now on your feet at 5. They didn't close that way, but U.S. stock markets today briefly dipped into bear territory. At least the S&P 500 did. With its decline from the all-time high we saw in January, reaching 20% at one point today, it looked like it could close in bear market territory, but for a market to be officially considered bear, it has to be down from its highs by 20%, and it has to stay there for 2 months. So we flirted with it today, and then we got back out of it.
Well, thankfully, we got back out of it.
Yes.
Now the question is what happens after this. Now to break all of this down for us is Sarah Shookman. And my goodness, there has been so much back and forth. This is really a focus of a lot of people's attention right now.
I know, and we've been talking about it a lot too, trying to make sense of it all. I mean, this is the possibility, right? We flirted with it today. It could be coming back Monday. Today was a bit of a wild ride as the S&P 500 briefly fell into a bear market. It closed in the green, just above that definition at 19% off its January high. So the first thing to note is this happens. It is part of how the market works, and we have been due for this correction we're now seeing. The volatility is the consistent here. Today, the market reversed its midday losses. And for the week, the Dow is off by 4% in what would be the first 8-week losing streak since the Great Depression. The S&P 500 is down 5% for the week, while the NASDAQ is off by about 6%. Now, the first thing Kevin Myeroff with Sequoia Financial Group told me today, here's what he says to do. Take a deep breath.
Bear markets do come. They tend not to last very long. Every single one of them is scary when you're going through it. And every single one of them is caused by something that we haven't seen before. And so we have the excesses of a pandemic on top of high inflation caused by a lot of money that was put out during that pandemic time period, and a supply chain issue that all hit at once.
One of the factors that will continue to impact how long this volatility lasts. He says he's watching how the Fed raising interest rates impacts the economy, what happens with the war in Ukraine, and how China continues to handle COVID shutdowns, as all of those are impacting our inflation. And they could change over the next 3 months, 6 months, or even longer than that.
All right, so a lot of folks have been we've told them not to, but maybe they took a peek at that 401k.
It's kind of hard not to.
Your heart starts to get a little fluttery and you get kind of cold and sweaty. What do we do?
Yeah, well, Kevin suggests what he calls his 3 R's. Number 1, relax. Number 2, reevaluate. And number 3, if your portfolio or your mix of investments is not really in line with your goals or the timeline you're working with, you might need to reallocate.
If you're really off, then you need to reallocate. Not pull out and try to time this, because then you have to be right twice. You have to pull out at the right time and get back in at the right time. Nobody could do that. And so if you follow the 3 R's, relax, reevaluate, and reallocate, you'll get yourself in a good position.
Now, he's been in the business 37 years. I know we talk to him a lot here, but he says nobody can time the market like that, or they would be managing everybody's money, right? So just trust that you can't get it right, and you should follow those 3 R's. And I think the focus has to be on the deep breaths, guys.
Yeah, relax. And I think we also have to remind ourselves that markets have always, over time, gone up.
Right.
Like, you will have temporary dips, but over the long haul, which is what we all are, we're all long haul investors, it always grows in time.
Exactly. And you see that if you look at the averages between the bear markets and the bull markets. The bear markets, the average is like 11 months or so, and you see this dip of like maybe 30%. So we could keep going further down here if we enter bear territory. But the bull markets, they last like 4 years on average, and they go up 150%. So it is worth it. Just hang in there.
Yeah, it all averages out. But whenever you have a stat that goes back to the Great Depression, you get my attention with it.
Definitely.
That's a long time. Sarah, thank you.
Thank you.